Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the odds of a near-term recession and what that could do to existing home sales. Logan, welcome back to the podcast.
It is wonderful to be here. As you can see, I'm getting ready for our Florida trip. We're going to be going to Florida a few times over the next a few weeks. So I'm really festive. I kind of got the Pat Riley thing, like the Miami Heat, and we're good to go.
Oh, it's a whole theme. I see. Yes, you have sort of a very a colorful shirt on. If people
very
are just
white, very White Lotus kind of thing.
Oh, okay. There we go. The White Lotus theme. Oh my gosh. Okay. So much has gone on since last we talked. It was Friday morning. We knew it was going to be wild. Tell me what happened on Monday in the market.
Sarah, today's an important day. Okay. This is Monday morning. And of course, last week we talked about, market volatility. President Trump is going to try to fire Powell, what's going on here. And we've always said this, and we've tried to keep constant with our themes from November 7th, 2024 to where we are today. We believe in showing a progression of what's happening because things can change very quickly. But we've said from the beginning, if Trump is going to try to do this, he needs a lower dollar, he needs lower gas prices, but he needs a lower 10-year yield. Right? He needs lower mortgages. If he's going to try to go at it in a trade war, because 2018-19 wasn't very successful and he had a better backdrop back then, but now it's getting a little bit late in the game without having all three of those things in. So today was the first day that I actually seen kind of Wall Street, conservative Wall Street people kind of throw in the towel. And I don't follow a lot of people. I only follow very few, and some of my more analytical, smarter friends who tend to be conservative have kind of gone into the recession camp right now. And I'm going to explain to you one of the Wall Street firms, Apollo, which said there was a 0% chance for a recession going into 2025 late last year. They upped it to 90% today. But wow. Why? It's not, anybody could say the word recession, but they gave a whole parameter of variables here. Number one, they said Doge is cutting, right? Firing people, something we brought up. You're firing people and you're withdrawing money from the economy. So just by that nature, the unemployment rate should increase if the labor force stays constant or grows. If the labor force detracts, then the unemployment rate can stay lower. Then they talked about tourism. Like tourism has fallen off a cliff. It looks like COVID. I mean, they're all waterfall dives from many countries. So you've got that negative. Then there's the uncertainty about tariffs. Like, what are we doing? Tariff on, tariff off, what percentage here? They're all like, we have 27 different plans. They say that's not great for business investment. Then they say confidence, consumer confidence is collapsing. Retail sales still positive. Home sales are still positive, but confidence is collapsing. Then they said business confidence, small business index, which is typically conservative, collapsing, right? And the uncertainty of how long this trade war lasts and what's the next stage is starting to freeze people. And you're going to get hit, like, example, truckers are going to get hit like they are already. Farmers are going to get hit. You put all of them together, this is what they call a voluntary trade reset recession. Neil Dutta, friend of mine's, very conservative, comes out on TV today, recession. But the kicker was President Donald Trump, after what he tweeted last night, we got the Sunday night tweet, I got he who controls the gold owns everything. I literally had a video of pouring gold on my whole body. But what he did this morning really showed his hand. And he said, the Federal Reserve has to cut rates because the economy is slowing, right? And when you go into that, what happened was the stock market was selling off in the morning like people anticipated, but the 10-year yield had been falling lower. We got to that 435 level again. But as soon as Trump talked about, you got to cut rates because the economy is slowing, you showed your other hand. And now everybody kind of said the market started to sell off even more aggressively. Bond yields started to tick up higher. The dollar goes to go down. So Trump has two of his three things. He's got the dollar lower. He's got energy prices lower, but the 10-year yield has gone up. Sarah, you'll remember this time period better than I do. But I remember 1981. I even put a picture of myself in 1981 with a Love Boat hat, sticking my two thumbs up in the air, smiling and going. And back in 1981, it was kind of the sell everything, sell all US assets. You're selling the bond market, you're selling the dollar, and you're selling stocks, right? It's very similar of that period right now. That is problematic. I think there is limits to what they can tolerate with the stock market being a bear market or correction, but they can't literally let the 10-year yield go up on them like this. And we saw that once. And some people were waiting for a trade deal with Japan, but Japan comes out and goes, we don't know. Every time they switch up the policy, something new is coming. So this is starting to get into the chaotic atmosphere. And you can't just tweet something and say, one of the things he said is that the trade things are going well. So as of right now, it's very chaotic. And some firms are saying, hey, listen, this continues, we're going to get a recession. So with that in mind, two things we're going to talk about. How do home sales act during recession? We had an internal Slack conversation on this, Joan, because I love this stuff more than anything. I did a little presentation, a dissertation for those that if you do have an Instagram account, if you want to see live videos of me talk, I do some of the things there so you can see the charts. But we're going to talk about how does housing act in recessions going back to all the recessions, going back to early 1980s. But first, what does the Fed do here? Because the Fed always says, hey, the economy's strong. There's uncertainty, but it's strong. And now you're starting to get more and more people saying, hey, no, this isn't working. And I've always said, labor over inflation. The way I looked at it back in 2022, what I would have done, and by the way, no one should ever have this kind of power. No, don't ever give one person that kind of power. Omnipotent, all-powerful beings, Federal Reserve, no. Want a series of people. The Fed funds rate, I would have stopped at 4%. Because the original plan I actually like, that they want the Fed funds rate to match the growth rate of PCE. Now, if we would have stayed to that, that's what President Trump was talking about today. He's like, look at the growth rate of inflation. There's no inflation, right? There is inflation, but there's, it's got two handles on it. If you didn't raise to 5.5, a lot of things would have been different. You would have had the disinflation anyway, right? Because the supply chains are working. And the Fed's forecasts stronger inflation data and weaker jobs in 2023. The exact opposite happened. The growth rate of inflation fell faster. Jobs actually did better. So it's not the economy booming or anything. It's just supply chains working. But now you're in a position to where can the Federal Reserve, with an honest face, keep on saying, well, the economy is strong and this and, we don't, or are you literally going to wait until the labor market breaks? So today, I'm saying they probably can't wait that long. And we have two Fed presidents now, both conservative, both are moving up in the rankings of the Federal Reserve. Powell's obviously done by 2026. They're saying labor over inflation. We're going to start to have what we talked about last week, a civil war between Fed presidents, a war between Powell and Trump. But you can do that if the economy stayed firm and the labor market didn't break. You could hold the policy as restrictive as possible. But now the question is, do they wait to see the labor market break? And then what? Then how do you handle that? Or do you try to get ahead of the curve? I've always said that they are naturally old and slow. But now that there's starting to be a unanimous, this is not good for the economy or jobs or anything like that. That goes into the dual mandate. So this just makes life for the Federal Reserve much harder because the thing they held their hat on all the time was the labor market. And if everyone sees or is connecting the dots like Apollo did, Apollo was like, we're going to do rate hikes this year. That's how confident they were on the economy. We're doing rate hikes.
In 2024, they said that?
2025. No, for 2025, they were talking about rate hikes. What if the next move is a rate hike? So now they flipped. So the question is now everyone's eyes are on the Fed now, because now you're getting more and more people that were bullish on the economy say, hey, listen, we have all these variables. They're all coming at once. And then President Trump shows his hand by saying, hey, listen, the economy is slowing down. We need lower rates, in that context. And as we talked in the last podcast, we did have a manufacturing recession in 2015-16. We were able to handle it. Rates were lower. So I think that's where we go from now on to the end of the year on this tug of war between the trade war tap dance, the Federal Reserve, Powell, Trump, Fed presidents talking about preemptive rate cuts as they did. And it just gets more interesting, Sarah. Every day it just gets more interesting.
It does. You brought up the tourism industry, and I don't think that anybody had that on their bingo card for this, because when you think about immigration, I thought about a lot of different things on that, but I didn't think about the fact that the way that they've gone about this is going to have a chilling effect on tourism. So that's a whole industry that might be affected, and you might lose jobs that maybe wasn't even on anybody's scorecard.
So remember the what we were looking for into 2025. What was the wild card? The wild card were the builders, that if rates go up higher and new home sales starts to contract, completed units, there's where the builders start laying off people. And every economic cycle that we've shown, residential construction workers lose their jobs. Well, oddly enough, rates did fall. Purchase application data for the builders, 5% year-over-year growth, 14% month-to-month growth. It isn't spectacular, but on that context, they have a monthly purchase application data. It's positive. Rates fell. It makes it harder to have these really big layoffs if new home sales are just stable. It has to really break below 2022 levels, or eventually the apartment unit layoffs start to occur. So that's something we keep an eye on. Now we have Doge. We have money taken away. We have now tourism. Now we have trade. Now we have farmers. Now we have truckers. We have, that's a safari. It got much bigger, right? And it's just one of these things with tourism. You could say it's like 1% of GDP. Some people would say if you take all the input factors of GDP, it's about 2.8 to 3.4%. But in any case, they chip. Right? They chip. And if consumer spending is coming in less tourism, right? You put all these things together. I think that was Apollo's case. You have too many variables going the wrong way. And when Trump said we need lower rates, I think even the White House is kind of like, all right, it's getting a little bit crazy out there, isn't it? So the stock market selling off Monday isn't so much. Bond yields, though, reversing throughout the day. When those are the things that we've seen that the White House doesn't really want to see happen, because that was part of their playbook. So complicated. Trade wars are not easy, right? Again, we've stressed this, the 2-year political cycle. And now you're going to have to start being mindful of Republican congressmen in the Senate and the House starting to hear from their constituents that, hey, what's going on here? I just got laid off, right? My farming things, my trucking business, all of a sudden, their job is for their constituents. You don't have a lot of extra seats in the House and the Senate to really go. So if you lose some of them, even before the midterms, you could get that kind of, pullback. And another variable to think of, DeSantis and some of the other presidential candidates that might put up, they will put up their names for the 2028 election. They're kind of sitting back, because if it is Vance that's going to be running for president, the trade war is him, right? So you got to remember that the trade policy was a very Republican Reagan kind of thing. So Ted Cruz, DeSantis, you could kind of see people just waiting back, right? It's politics, right? They sharpen their knives when nobody's watching. So we just have to decide. We have to look at things. And of course, I hate politics. I'm political economics. I hate it. But because this policy is so big, it's filtering itself in a lot of data lines. But more interesting. But now the question about what about housing?
And that's it. That is my question. It's okay, let's talk about, because those lower rates, even if everything else is kind of going crazy, if we get lower rates, that's better for housing, right?
So one of the reasons why I have stressed time and time again, it's the lowest home sales ever recorded in history. When you take the civilian labor force, the workforce, our demographics, it's really remarkable where home sales are. However, this year, with all the drama headlines, purchase applications and data are up year to date, and it's up year over year. Even for me, I'm surprised because the rates have been elevated to the upside still. But the one difference about this, and we show this in our Slack, in 2024, the 10-year yield got to the corridor line at the end of the year, I think December 28th, and it bounced. And it bounced and it went up higher. The mortgage rates went from 6.63 all the way to 7.5%. During that time frame, the 18-week period that we track and focus on, 14 negative prints, 2 flat prints, 2 positive prints. Very negative. The volumes weren't crashing anything. We don't have any volume crashes, but the weeklies were very negative. No year-over-year growth. This year, see, a lot of people are the tariff this, tariff that. Forget about tariffs. It's a 10-year yield. The housing market revolves around the 10-year. So what happened this year is that on January 14th, the 10-year yield peaked, mortgage rates peaked, and then it started going lower. So for the first time in many years, purchase application data is not negative. It's got a positive week with elevated rates. See, if mortgage rates were at 6%, and then it makes sense to me. But here at elevated rates, positive year to date, positive year, all because the 10-year yield was falling. And I thought about this, I talked about this, oh my God, we're almost having a normal purchase application data curve, right? In the previous decade, it was very simple. We highlight the second week of January to the first week of May. We're almost at the first week of May. That's the seasonal demand curve of purchase application data. You always want to track the year-over-year data on that. And then after May, total volumes always fall. And we do it over and over again. COVID has messed up a lot of things, but it looks like a normal seasonal demand curve. We have about 2 more weeks left. We don't know when what the purchase application data is going to look like now, but still, in April, I wouldn't have been able to say this in the last 2 years. The last 2 years I've already written. Sales have peaked on the monthly side. That's it. I can't do it because the forward-looking data is still positive. So we're going to get the existing home sales report this week. It should have a month-to-month decline because our weekly data is a little bit ahead of the NAR's existing home sales, and it's just recently gotten better. So it's not going to filter in this report. But the reason I bring this up is I took every single economic cycle we had starting from 1981. And then I drew lines. We call it crayon economics because we want to keep it so simple. Every single recession, because people say nobody's going to buy a house. That's not been the case. So,
okay, so what about the rates?
Let me show it to you guys. So I took a chart. I drew red lines, and I showed every single recession post 1980. What happens is sales tend to get weaker going into a recession. Why? Why does this happen, Sarah Wheeler? Rates go up, sales go down. Right? So we take the let me go line by line on every single one. The 1980s recession, double dip recession, selling assets, bond yields went up, stocks sold off, dollar was getting gas, nobody could buy a house, affordability was worse. Oh my God, mortgage rates fell 2.5%. Sales are rising. Fell 5%. The chart actually looks like a vertical increase, like one of the sharpest increases we've seen in recent history in a time where people said nobody's ever going to afford a house ever again. Oh, I'm shocked. It happened because nobody has a job, Sarah. Double dip recession, the confidence was terrible. Credit data was terrible back then. Vertical. Now, rates fell in that recession. Sales went up. Very low bar. Then the 1991 recession. Okay, so 1991, home sales were falling for years. Going into the recession, we saw that one last dip in the recession data line, and then shocked, Sarah. Nobody has a job. Nobody's working. Still, millions of people bought homes, and it increased. As the recession happened, sales started to increase. 2000, tech recession. Not much happening. Sales didn't really go anywhere during the recession, and then as rates fell, it started to pick up. So I don't even have any kind of negative curve in the existing home sales report because it impacted new home sales data a little bit more, but not much. And then sales starts to increase. There you go. That's the other recession. 2008 even, credit boom, credit bust, huge collapse in home sales, credit breaking, underwater mortgages, short sales, foreclosures, all these things. Sales bottomed. Eventually rates went lower. Very slow. For those of you who don't remember my work in the last decade, the whole concept was we're going to have the weakest housing recovery in the history of America, and nothing's going to really change in the big scales until years 2020 to 2024. But even back then, sales started to slow. So those are the recessions. COVID, we take that out. COVID, okay, housing broke out before COVID. The dip that we saw is behavior, right? That wasn't because people didn't want to buy homes. It was behavior, the fear of, oh my God, we're all going to die. Oh my God, we're all going to live. Mortgage rates are 3%. Now, what are we doing here? Here, the lowest home sales ever recorded in history, 2023, 2024, near 5 million total home sales with elevated rates, elevated prices, elevated taxes, elevated insurance, and yet home sales aren't crashing anymore. But this year, amongst all the headlines with elevated rates, it's the first year in many years purchase application data is positive. So when people say the tariffs are right, okay, if the tariffs are really freaking people out, then purchase application data should be negative. And it should be negative even if rates went low. That's not the case. Now, you don't do long-term damages to the economy without getting hit in America on the political side. Everyone knows this. There are rules, midterm elections, everything. The thing with tariffs is that Congress can take it back. Then all this game plan, everything that's going just does not work well. So this is why Bassett, Trump, everyone wants lower mortgage rates, because if people are buying homes and driving and they see lower gas prices, they're buying homes again. What is that? They're going to go, remember the Biden era? You couldn't do that back then. That's how they're marketing this thing, because they know going into a trade war, it's going to cause a lot of drama and those things should happen. It's just that the 10-year yield has not cooperated as much as they like, right? They can take the stock market being a correction, even in a bear market, but here, they need that rates to go lower. This is why Trump is going full force in it. So imagine, ask yourself this, everybody listening. You have your family's life right here. There's going to be a poll or a question. The question is, if mortgage rates were at 5% for the next 12 months, do you believe home sales will go down or up, no matter what happens in the economy? No equivocation here. There is no delay, pause, or anything. My hand is up. History has shown us it goes up, especially from this record low level. So I urge people, go look at existing home sales back to 1968. Look at the recessions. It's a trend. Sales go down. They stall out at very, very low levels. Rates go lower. Households form. Jobs have been created during that period of time. And then it picks up. Now, there's going to be a one level bounce. After that, we'll talk about next. But if this occurs, we have to be mindful of history here.
But the whole question is, if you're in housing, it's like, okay, when and how do we get those lower rates? Where we are right now, how do we get even down to 6%?
Well, we've had 6% twice in the last few years, but all of those times were the labor market. Everyone's afraid of the labor market. The bond market is afraid of, this is where the fight is going to be, right? Because I don't believe the Fed can hide behind this anymore. Right? It's one thing if Biden was president and people say the jobs number is fake and whatever it is, it's not the case anymore. Everyone's kind of all in on the economy slowing down. And if you have a dual mandate, see, here's where I think the Fed is at risk. What if the inflation data never took off? What if the weakness in the economy made consumption go down and it never went as high? And here we are waiting, even though the labor data is breaking on them, for them to be aggressive. Then you could say, well, they were late on COVID. Now they're late on this. Goodbye, Jerome Powell. You blew it on both sides. It starts to get more difficult, right? We always say that when you put this trade war variable in it, both sides can make an error here, right? And you got both sides who don't really like each other. Okay, so it's more problematic when there's no drama and this is it. But I made the point that the Fed was not very dovish anyway going into this year. They're like, well, you know, we might be near neutral. This is before tariffs. This is before we're getting near neutral policy. We'll see if we need to cut him. Or so on this, go get him, Trump. On this very thing, on this, I 100% agree with him. He should have just gone after it right then. Okay, but when you're waiting,
let's back up there, because you're also the person who said that the president should not be interfering in the Fed. So how does Trump?
You can talk the Fed people down all you want. This happens all the time. Firing the Federal Reserve, firing him, no. That's a whole the bond market. But if you want to say, hey guys, listen, where's your neutral rate? Housing has been in a recession for, to tell me, what are we waiting for? So this goes into a policy debate. Now, I could also argue that as soon as Trump won, everybody said, okay, he's going to do tariffs. Let's see what it is, right? And the tariffs are going to really mess up some of the economic data. We're already seeing people like getting ahead of more purchases because everyone is afraid of what's going to cost a few months. So all this data is all messed up. But in this case, they were not dovish beforehand. We had Fed presidents talking about, are we near neutral? Maybe we don't need to cut rates anymore. So there's a lot of things to go around, but now they can't hide anymore because we have conservative Wall Street people saying, hey, this is not good. This is a recession. We have Trump saying, hey, the economy is slowing down. We have a Fed that has a dual mandate. And what do we say? Sarah, that dual mandate is going to be the good, the bad, and the ugly. Get those 6 shooters out. Clint Eastwood.
You were reaching for your belt, but I was like, I'm not sure what you're going for here.
No, we got the 6 shooters out. It's a duel. It is a duel. Gotcha. Who's going to shoot who's first in this dual mandate? Because the other dual mandate says that the Feds are going to wait and then they're going to say, but now it gets interesting because there's no more a consensus anymore about the economy. They go, if this keeps on continuing. Now, another hypothetical, let's say we make a hell of a lot of trade deals in the next 2 or 3 weeks. This all goes away, right? There's other things you could worry about, but this portion of it goes away. So the Fed says, we don't know what's happening. We don't know what's going on here. So you could see everyone has a case here. But it is interesting how today was a day where I think a lot of people just had the realization, especially when Trump reaffirmed it, asking for, you got to get your rate cuts ahead of time because the economy is slowing. This is what Christopher Waller talked about, if the economy slows down, I want to get ahead of it by doing preemptive rate cuts. And then Bowman, labor over inflation. Oh, I've been a big hawk on inflation, but now I'm going to focus on the labor market. This is not by accident.
Right.
This is all the tactical. Everybody does their tactical. They're putting their careers and everything on the lines. And if this breaks, oh, Sarah Wheeler, the last few weeks, it's going to be cupcake. Be like watching the Care Bears and the strawberry shortcake have a little party. It's going to be Godzilla and Kong and the pits of hell fighting demons and orcs and goblins with Trump and the Fed. If that happens, it gets harder for the Fed to sit there and go, we're going to wait. And that's the probability of chaos. All agents of chaos create this. COVID was an agent of chaos. 2022 was the craziest year ever. 2022 was agents of chaos. You're just not sure. Here, nobody's sure, but they're starting to become a consensus now that this is not going as planned. And there's a reason why Trump said we need preemptive rate cuts. The economy's slowing.
So we have about 2 weeks before we get that Jobs Friday number. And
well, the Jobs Friday, again, people are looking out. The jobs reports the past 2 months, fine. Jobless claims, fine, right? So we always say labor over inflation. There are key data lines to track. They have not broken yet. People are now looking ahead if this keeps on continuing. So that's the thing about, we're not talking about the current data, retail sales beat estimates. I know a lot of people said front loading again, but it's when jobless claims start to increase, right? It's where it gets very problematic because every single economic cycle post World War II, you start to see this. So today was one of those days where you start to get everyone's, kind of on the same page here. If this keeps on going, you're going to get this. But if it does happen, let's say the Fed cuts 1.5%, mortgage rates go sub 6%, you're going to get those people, Sarah. I guarantee you 100%, no equivocation. They're going to go, who's going to buy the homes? Nobody has a job. Nobody has income. So, homie, we're going to do a countdown. That's what I'm going to do. I'm going to count every single person in America working, every jobs report. And I go, show me the person that says no one's working. Who is he? Where did he go to college? That person needs to get a refund because here's 162 million people working, and where's the jobs? Oh, you can see I'm very excited about this.
I can see that. You are very excited about that. Well, we will be very excited to see how this shakes out. No one wants a recession. You and I have talked about this. No one wants people to lose their jobs. But if we're going to go into a recession, there is a benefit to those in housing. And we would, we'd love to see that part of it.
Time will tell, but again, we'll track everything day in and day out. But again, we've always stressed there's a window here for Trump to get deals, right? And he's obviously talking deals because he's talking to Japan to get the deals. A lot of people thought, people are now taking bets about which country, like it's South Korea, Vietnam, Japan, all this stuff. But obviously it's deals now, right? Trying to get deals done. This is not going to be the universal tariff, no deals. Here we go. We're going to change the entire. Now we're talking about time, Sarah. Oh, midterm elections. It's a bane of every sitting president that gets it, but that midterms are coming up. And this is the unfortunate reality for Trump is that tariffs are something Congress can take back. It's not like policy or anything like that. Tariffs are something, and he still has to pass, budget, the tax cuts. He hasn't got tax cuts yet. So I would say this, we had this discussion with Wall Street traders and I said, if Trump waited a year, let the Fed cut rates, you would have the inflation data be slower. You would have a better footing. Powell is on the verge of leaving in 2026. If you want to put Warsh in there at that point, give yourself a little bit of time and leeway, a better footing, get your tax cuts, get whatever you want, then go for it like you did in 2018. But the problem going in right away and doing tariff on, tariff off and bluffing, and people say he had to do something, he did it, and it was Godzilla. Right. And markets are so one day at a time. Again, we'll track all the key data designs each week, but a very interesting day, very interesting market day. And think 1981. I was 6, Sarah. And
I was only in middle school. It's not like I was super old or anything. Come on.
No, you weren't super older. But bond yields sold off, dollars sold off, stocks sold off. So this reminds me a lot of that and what happened in 82 and those periods of time. So I encourage everybody to go see the visuals of existing home sales going back. You can see those charts. You can see it. And there's a progression, sales going lower, stalls out, rates go lower because you're working from a low bar. Sales tend to move up higher off of that.
Logan, thank you so much for being on again. We will talk again soon as always. Thank you.
My pleasure.